The time to buy is when there's blood in the streets, Baron Rothschild famously said, even if the blood is your own. Most people hear that and think it's about being brave during a stock market crash. But the top 1%, the institutional architects of the modern financial system, view that quote through a different lens. They don't see blood, they see math. Specifically, the hidden math of the top 1% that dictates why your grocery bills are exploding while their asset portfolios are reaching all-time highs. While the average American is checking their banking app to see if they can afford eggs and gas, the Federal Reserve is pulling levers that determine the next decade of wealth distribution. Right now, the U.S. economy is sitting in a massive structural crossroads. Inflation, treasury yields, and a $34 trillion debt mountain are all converging. Most people are looking at the surface ripples, but what's happening beneath the surface of the U.S. economy right now could change everything you thought you knew about building wealth. If you feel like you're running faster just to stay in the same place, you're not imagining it. The American middle class is currently caught in a vice. On one side, you have mortgage rates that have hovered between 6 and 7%, effectively freezing the housing market. On the other, you have a cumulative inflation spike that has made the 2019 dollar feel like pocket change. While the American middle class is one of you is checking their banking app to see if they can afford eggs and gas. Let's look at the hard data. U.S. household debt hit a record $17.5 trillion recently. Credit card delinquencies are surging at the fastest pace since the 2008 Great Financial Crisis. The hidden math the elite understand is that in a debt-based system, those who own the assets benefit from inflation, while those who earn a wage are taxed by it. It is a silent transfer of purchasing power. If you want U.S. macro explained visually and without the media noise or political theater, subscribe to Sketchy Man Finance. That's what we do here. We look at the data the headlines ignore. Now, to understand where we're going, we have to look at the ghost of a man who once saved the dollar by breaking the economy's back. To understand the hidden math of the top 1%, we have to go back to 1979. The U.S. was in an inflationary death spiral. CPI, the Consumer Price Index, was peaking at 14.8%. The American public was losing faith in the greenback. Enter Paul Volcker. Volcker didn't use a scalpel, he used a sledgehammer. He pushed the Fed funds rate to nearly 20%. Imagine that today. Your mortgage wouldn't be 7%, it would be 18%. The economy crashed, unemployment spiked, but he killed the inflation dragon. Fast forward to the 2020-2021 era, the U.S. witnessed a surge in the M2 money supply, the total amount of cash and checking deposits that was unlike anything in history. We increased the money supply roughly 25% in a single year. The math is simple. When you have more dollars chasing the same amount of goods, the price of those goods must rise. The 1% knew this. They moved into equities, real estate, and hard assets before the spike. The retail investor, they were left holding the bag of transitory inflation. Today, we see the S&P 500 trading at a forward PE ratio well above its 10-year historical average of around 18x. We have a U.S. debt-to-GDP ratio sitting at over 120%. In the 1980s, we had high inflation but low debt. Today, we have sticky inflation and astronomical debt. The Fed is trapped in a room where the walls are closing in. So, let's talk about the data villain in this story. It's not just one number, it's the relationship between three things: the 10-year Treasury yield, core CPI, and the Fed's higher-for-longer policy. When the 10-year Treasury yield rises, it's the market saying, "We don't believe inflation is dead yet." It's the benchmark for everything, from your car loan to the interest the government pays on its $34 trillion debt. The Fed is currently squeezing the system. By keeping rates elevated, they're trying to drain the excess liquidity they pumped in during the pandemic. But here is the problem. The U.S. government is currently spending roughly $1 trillion every 100 days. The Fed is trying to cool the economy, the brake, while the Treasury is running massive deficits, the gas. This friction creates volatility. If inflation re-accelerates, what we call round two, the Fed will be forced to keep rates high even as the economy slows. This is the stagflation nightmare of the 70s. On the flip side, if they cut rates too early to save the housing market, they risk letting inflation run wild again, devaluing the dollar. The hidden math of the top 1% relies on understanding which way this pendulum will swing. They don't guess, they position for both. I want to pause here and ask you, do you believe the Fed actually has inflation under control and we're heading for a soft landing? Or are we just in the eye of the storm before round 2? Let me know in the comments. I read them to see where the real-world sentiment is shifting. Let's translate this macro speak into what actually happens to your wallet. The hidden math of the top 1% creates different realities for different people. For homeowners, if you locked in a 3% mortgage in 2021, you have what analysts call golden handcuffs. You can't afford to move because a new loan would double your payment. You are wealthy on paper due to home equity, but you are illiquid. For renters, you are feeling the brunt of the data villain. As long as housing supply remains low and interest rates stay high, landlords pass those costs down. The American dream of ownership is being mathematically priced out of reach for many. For stock investors and 401k savers, the days of easy money, where every stock went up because rates were zero, are over. We're moving into a stock pickers market. Serious investors are looking at companies with actual cash flow and low debt, not just growth stories fueled by cheap credit. At Sketchy Finance, we focus on understanding the cycle, not reacting emotionally to the daily red or green on your screen. The 1% don't panic when the S&P 500 drops 2%. They wonder if the 10-year yield is signaling a structural shift in the global economy. They play the long game. As we look toward the next 12 to 18 months, we have to embrace the strategic gray area. The media loves extremes. They want to sell you a total market collapse or a permanent bull market. The truth is usually much more boring and much more technical. The hidden math of the top 1% suggests a period of financial repression. This is when inflation stays slightly higher than interest rates, effectively melting away the real value of the government's debt at the expense of savers. In this environment, risk management is more important than chasing the next big thing. It's about liquidity positioning, having cash ready when the blood in the streets actually arrives. Asset allocation, not being over-leveraged in a high-rate environment. Long-term discipline, understanding that the U.S. economy moves in cycles and we are currently in the late cycle phase. We're not here to predict the exact day of a crash. Anyone who tells you they can is selling something. We're here to observe the data, understand the Fed's playbook, and ensure we're not the ones liquidated when the math catches up to the system. If you value serious macro analysis focused on the U.S. economy without the hype, the panic, or the political bias, subscribe to Sketchy Finance. We're building a community of informed investors who want to see the whiteboard, not the teleprompter. Remember, the math doesn't care about your feelings, but it deeply cares about your patience. Stay analytical, stay calm. I'll see you in the next cycle.